Good afternoon, everybody. Hope you guys can hear me. My name is Sean van den Berg. Welcome to our last webinar for the year. Today we're going to talk about point and figure charts, a bit more advanced technical analysis. I hope you guys find it interesting. Yeah, so if you guys can hear me, just confirm, send me a text that you can hear me clearly, and we can get going. Okay. Here's the agenda for today. What we're going to do is just introduce point and figure charts, some background to it, and then spend some time on explaining how to construct a point and figure chart. Obviously, this is if you're going to do it manually. There are software programs that do it for you now. And I'm going to spend a lot of time on some of the basic point and figure chart formations. Because of time constraints, I obviously can't go through all of them. And then I'm going to spend some time on what I find the most useful part of point and figure charts is how to determine price objectives. It's great for trading to help you ascertain where the price targets would be. Okay, so this presentation is based on a tutorial, so you can go find it on our website. If you click on resources, and on the next page you'll find a section called tutorials, and then go look for tutorial number 10. So that's where you find additional information. Just remember, as we do with every webinar, this webinar is being recorded. So those of you that are attending or participating in this webinar will be getting the presentation, and number 2, the actual recording. So the idea there is that for review purposes, go through the presentation again. Any questions you have, you're welcome to email me or phone me. Okay. So let's get into the nitty-gritties. So for some background, let me just confirm you guys can hear me properly. Are there any questions coming through? Audio is good. Yes, I can hear. Yeah, okay, clearly. Great. Thanks a lot, guys. Thanks, Sean. Thanks, Peter. Okay. It's one or two of you saying it's a bit of echo. I wouldn't know why it's echoing because I've got my speakers off to the side. But most of you can hear me clearly. Okay. Okay, let's talk about price charts. Remember, the way to display a price chart is either a line chart or a bar chart, and obviously point and figure chart is also a price chart. So this goes into some of the background. Point and figure charts have been around for a long time. They've been around for over 100 years. It's one of the first methods used for technical analysis to track share prices. I know that Japanese candlesticks have been around for about 1,000 years. Remember, they were tracking the rice futures. But point and figure charts were the first to be used for tracking prices. I personally used also the very first charts I ever used way before software, and I was drawing it on graph paper or noughts and crosses. So I have a affinity for point and figure charts. I enjoy them. It's part of the arsenal, part of your toolbox. As a technical analyst. But the main thing what I like about point and figure charts, it's the clearest and most unequivocal form of technical analysis. In other words, it shows you the true picture of supply and demand. That's what I like about point and figure charts. So it simplifies a lot. Whereas closing line charts and bar charts are three-dimensional. Okay, we're looking at price, time, and volume. Point and figure charts, as I say, simplified, it's only looking at price. It's one-dimensional. So yeah, you can see a screenshot of a line chart or a closing line chart. You've got two axes. You've got your horizontal axis, which is referring to time, and your vertical axis or the y-axis referring to price. Obviously, this is the JSE All-Share Index, so the price is referring to points. And then obviously, you go one step further, you have what they call bar charts, and obviously bar charts give you a bit more information. You have the high for the day, the low for the day, where the market opened, where the market closed, and usually displayed at the bottom of the screen would be a histogram that displays the number of shares traded or the volume. Okay, so that is the two most popular line charts or price charts to display information. Now, the nice thing about bar charts and things like that also, you can look at the extremes, and that's how you draw your support and trend lines and support and resistance levels. So in this chart here, for example, it highlights, if I bring in my little cursor here quickly, my spotlight, obviously a support level. It also highlights a resistance level. You can see a bit of a sideways market, and then from there you can also draw in your trend lines. So when it comes to point and figure charts, very similar. You can draw in your support and resistance levels, but also you can draw in what they call a 45-degree angle chart. And we'll talk about trend lines a bit later. So this shows you a true picture of supply and demand, a breakout above or below as a resistance trend line. Okay, so let's get into the construction of point and figure charts. As I said, this presentation is being recorded. Please review this stuff again. And again, as I say, the tutorial gives you a bit more information. But I refer point and figure charts as noughts and crosses. So a chart is constructed using a vertical row of crosses and noughts to indicate the rises and falls in the share price respectively. Okay, so this little diagram here, when the price goes up, the price rise is indicated by a vertical row of X's. So you can see in this situation, the share went from 10 cents to 70 cents. Okay, and that's obviously indicated by a vertical row of X's. On the next chart, you'll see that when the price goes down, the price fall is indicated by a vertical row of zeros or noughts. Okay. In this situation, the share price declines from 40 cents, okay, or to 40 cents rather. That drop is indicated by a vertical row of X's in the next column, obviously the column to the right. Okay. As the prices move up and down, the chart will plot the extent of each move. Okay. It's therefore important to be able to draw a distinction. And this is where point and figure charts is very, very helpful. And your goal as a technical analyst is to determine, is this a continuation of the current trend or is it the beginning of a new trend? And this is where, as I say, I find the big advantage of point and figure charts. It helps you determine that. Okay. So let's get into a bit more of the technicals around it. We call this chart we're looking at the moment a 10 by 3 chart. The 10 represents the price change, or in other words, what we call the box size. So this box size is the amount that the share price must move to make a new cross or a new zero. You can see it goes from 10 cents to 20 cents. Okay, so that's what we're talking about, the box size. So each little cross or zero represents 10 cents. Okay. Point and figure charts ignores the smaller price movements. So if the price only went up 5 cents, nothing will be displayed. Okay, so it has to move by at least 10 cents to have one little nought or one little cross. So that's the 10 representing the 10 cents or box size. The 3 represents what we call the 3 points reversal chart. Okay, the share price must move at least 3 times the box size before we have a change in trend and create a line of noughts and crosses. Okay, so in this situation, the share price must move at 3 times 10 cents, in other words, 30 cents before we have a change in trend. And you'll see that we draw the next line, next column, one row lower. Okay, so and that's how we start building up the charts. Okay, so that's a bit the background. So let's talk about some chart formations. I'm going to highlight 5 bullish and 5 bearish in that tutorial on the website. I think there's 8 in total or 9 in total. So just because of time constraints, I'm just going to go through the basics here. Okay. So let's talk about a double top. Like we have with bar charts, very similar thinking behind it. This is a basic bar chart in a bull market. So obviously, it consists of 3 charts. First of all, you don't have anything less than 3 columns. It's impossible to have less than 3 columns. So we always have 3. That's a minimum, 3 columns, and obviously everything is derived from that, or combinations of this basic chart pattern. So double top is defined as a column of X's rising to the same level as the previous column of X's, and then we're breaking out above that. So we break above resistance and obviously exceeding it. So that's where the bull signal is given when we break up above resistance. Yeah. So the implications is that the price should continue moving upwards. It's quite a common signal, this, but it's not very reliable and doesn't yield good results. So a lot of traders would either you've got a choice: either you act on the original breakout, or you're going to wait for more complex chart patterns going forward. So obviously all these examples, there are practical examples behind it. So in this situation, We have our first top at 29, so obviously we have rising prices. And then we have a decline down to 26 cents, and then we have another rally, goes above, back to 29, so that's our double top, if you guys can see that. Okay, and the minute we break up above that, that's where we've got our buy signal. So I've substituted that particular cross for a B representing the buy signal. Okay, so they break out above the double top, registers the buy signal. We have the opposite, obviously, with a bottom top, a double bottom. This is a basic chart pattern in the bear market. Again, we need at least 3 columns. Okay, a double bottom is defined by a column of falling zeros to the same level as the previous column of zeros, and then we drop lower. So once it breaks through that support level, that's where we get our sell signal. Okay, so there we go. We have our first little decline down to 27 cents. Then we have a little rally back to 30 cents. And then we have our next decline back to 27 to that same level again. So that's our double bottom at that level. The minute we break out below the support, imagine drawing a horizontal trend line here. That will be break below support. And I substituted that little zero for a S representing a sell signal. So this is a basic chart pattern in point and figure charts. And from here we just build on. So obviously the next step from there, we just have more columns. The more columns we have, the more reliable the signal becomes. So yeah, we're talking about what they call a bullish signal. This is one of 2 classic chart patterns that you use most of the time in technical analysis, especially with point and figure charts. So it's a very special form of what I call a double top pattern. What we do now is we're adding further confirmation. And that further confirmation comes in the form of a higher bottom followed by a higher top. So we talk about a bull market making higher highs and higher lows. It's very similar thinking behind this. As long as the share continues to make higher bottoms or higher tops, the trend is considered bullish. Okay. So what's important to understand is the very first time we make a higher top, after making a higher bottom, that's when it gives you that signal to buy. So always think about, this is showing you the true picture of supply and demand. In this scenario, the thinking behind it is that demand is overcoming supply, and obviously that we are ready now for upward move. There's been accumulation. Okay, we're building up a base at a certain level, and now we built up this base, and now prices will continue from this level. So remember, our minimum columns we need is 3. In this chart pattern, we need 4 vertical columns. Okay, so this is a bit more reliable in the sense that it's a better signal than a double top. So yeah, it looks like there's our rising bottoms. Okay, and we have our rising tops here. So in this situation, we have a bottom at 25 cents. Okay, then a higher bottom at 27. Okay, that's what we're talking about here. Okay, and then we have a higher top at 32. So that was a double top, and it is our buy signal there. Okay, so all it is that that's what you're looking for. This higher bottom, okay, and obviously a higher top. And that's, as I say, more reliable in the sense that it's got 4 columns, and we build up from there. So I'm just going to, I know it gets a bit more complicated, but just bear with me when you, as I say, please review this presentation and make more sense when you go through it again. Here's another alternative. Again, we have a bottom at 25 cents and a much higher bottom at 29. But I still have a higher top also. So there's our double top and there's our buy signal. So as long as we have higher highs and higher bottoms, that's the kind of signal you're looking for. Okay. Opposite, when it comes to the bearish signal, again, it's a classic pattern on the bear side. We just need lower tops and lower bottoms. Again, we need 4 columns. I'm not going to go into too much detail here because of time constraints. There's a lot to get through. Okay. In this situation here, you can see that we have a top at 33 cents. A top at 33 cents and a lower top at 31. And then we have our double bottom and we have our sell signal there. So again, it's a bit more reliable than just a pure double top or double bottom in the sense that lower highs, lower lows. Okay, same thing here. There we go. There's our high, there's our lower high, there's our double bottom. We break out through that. There's our sell signal. Okay. So to keep those questions coming, I know you guys are hearing me clearly now. Just any questions coming through. Okay, everything's okay so far. Gus, you're asking long questions here. Okay, how soon is it possible we could have a webinar on what indicators are best suited to trade CFDs? I've looked around for good books on the subject, but can't find any, and I've tried the internet. Gus, okay, it's off the subject a bit, but there's no specific indicators to trade CFDs specifically. Remember, it's technical analysis in general. So yeah, it's using the normal price charts. I like to use the basics, breakout of support and resistance trend lines, but then also adding moving averages. I like to use the 50-day and the 200-day, and I use simple technical indicators like the RSI, stochastic, MACD as secondary indicators, and then also obviously on balance volume price trend. So it's just normal traditional indicators you can apply to CFDs. Okay. So I know it's a bit of a subject, guys, but just bear with me. I hope that answers your question, Gus. Yeah, that's the only question coming along so far. Here's another question from Johan. It says, can we use other techniques, other technical indicators with the pointing figure charts? Yes, you can, and I suggest you do use that to confirm. You don't use pointing figure charts just by itself. You can't obviously apply the technical indicators on the same charts as the pointing figure charts, because remember it's one-dimensional. But obviously you want to look at support and resistance levels and confirm it by using other indicators. Okay. So yeah, thanks for the questions. Keep them coming through as we go along. And just try and make it more context specific. Okay. So we spoke about a bearish signal. It's just obviously adding on to the double top, double bottom, and just as 4 columns. So we're just adding on to it. Let's talk about the triple top. This is the second of the 2 classic chart patterns. This is also used for timing a purchase, but unlike the bullish chart pattern, we're only looking at the action at the tops, not so much the bottom is important. So it's the actions at the previous tops that will give us the buy signal. Yeah, we need a minimum of 5 vertical columns. So the more columns you add on, the better. And you'll see just how when we come to the horizontal count, where this is also very important. So all that is necessary is the penetration of 2 previous tops to give us our buy signal. And you'll see in the next chart what I mean by that. It's a very strong buy signal. It's a breakout above resistance, and obviously it's very significant, a breakout above that resistance level. So here's our triple top, 1, 2, 3, at that level of 20 cents. Okay, and then we need a breakout above that triple top. So there we break out above it. That's your buy signal being replaced. The B replacing the little cross there. Very, very reliable. So demand is overcoming supply. The buyers are overcoming the sellers. Remember, these are all sellers at 20 cents. Eventually, the buyers beat them and then moved up above it. The sellers move out. There are more buyers coming in. Demand is overcoming supply. On the other side of the coin, he has exactly the same thing. Very similar. We have a base at 5 cents. Okay, and then we have a base between 5 cents and 25 cents. Okay, there's our long-term double top, and there's our breakout above it. Okay, so again, what's important is just the 5 columns. So it does get a bit complicated. It sounds a bit complicated, but it's very easy. Some people would go on the buy signal over here, being the double bottom here. That will be a buy signal for some of them. That's just looking at the double top. And as I say, just adding more columns gives you more confidence in knowing that that's a buy signal there. Okay, so that's looking at 5 columns instead of 3. So the triple bottom uses in conjunction with a bearish signal. Okay, but again, it's the actions at the previous bottom is what's important. Again, very strong signal at a support level. There's our triple bottom. Okay, you can imagine drawing a little a short support trend line or a level below that 42 cents. And then when we break through that, supply is overcoming the demand. So there's more sellers and buyers pushing the price down. That will get your sell signal. Same scenario here as we spoke previously. Some of you might get in over here, so that's double bottom. You might say, okay, that's my sell signal. But I suggest you look at more columns and then wait for a further confirmation. It just gives you much more of a better signal. Okay. And these are my 2 favorite indicators, bullish and bearish symmetrical triangles. When we talk about normal bar charts, I like to use what they call continuation patterns, and a symmetrical triangle is part of a continuation pattern, and this helps you determine that the trend will be continuing. Again, we need a minimum of 5 vertical columns, but it can be longer, and obviously the longer, the better. Okay. All it is a variation of the bullish signal pattern. It consists of obviously both zeros and X's, but they're shrinking until such time we have this breakout. So it's like a triangle. You see in the next graph, and I'll show you that we have higher bottoms and higher tops. Higher bottoms and lower tops. It's a form like a triangle. This is one of the most profitable chart formations you're looking for, and we have an average gain of 30%. And obviously the durations are about 5.4 months. So it's a bit more of a medium-term trend continuation. That's what the kind of thing you're looking for. We have lower bottoms and lower tops, creating this little triangle. Okay, so we have this lower bottoms. Higher bottoms. You can see that these are our bottom at 31 and the higher bottom at 33, and then our higher tops, okay, at 37. And we have this breakout of that. We're talking about trend lines just now, but you can have this kind of pattern. So it breaks out of it, and then we have this little movement up. Very strong pattern. What's important again, we need 5 columns to create this kind of chart pattern. The opposite is the bearish to medical triangle, and there's our high, we have a lower high, and we have our lower lows. Okay, so that's a bullish pattern, and we have our little triangle drawn from that. So there's our double bottom, and there's our sell signal. Okay, I'm just going through this a bit faster because obviously to accommodate some questions, and there's a lot of information I want to try and go through. Okay, now the bullish signal reverse pattern. Now this doesn't happen very often. It's a common occurrence, but it's a very strong pattern against the trend. So you can see we have this scenario where falling tops and we have falling bottoms. And then suddenly we have this reverse, oopsie, let me go back, we have this reversal very strongly against it. So there's our double top as such, and there's our buy signal. Okay. Now remember, it's been falling all the time, and that buy signal there, it's going seriously against the trend. It's a very, very strong signal. Okay. So it usually yields a very substantial profit. And obviously, if you're not watching the market, you miss this opportunity. So very strong chart pattern. This. You see how many columns we need. It consists of 4 columns, but can be more. Okay. On the other side of the coin, here we got rising bottoms and rising tops, and suddenly we have this changing trend. So there's our double bottom, and there's our sell signal. Again, very strong. Okay, the sellers are overcoming the buyers, and obviously we have a very strong, unexpected reversal of the trend. Okay. Again, if you're not watching the market, you can miss the opportunity. Okay, so trend lines are useful in the sense that it's a tool that you use. It's a standard feature in most technical analysis and when you do analysis. Obviously, it highlights the trends, but also highlights support and resistance levels. So in bar charts, obviously, you'll draw between 2 points. With point and figure charts, you're either going to use a flat horizontal line, that'll be very short lines, or alternatively a 45-degree angle. Okay. If it's less than that or more than that, you ignore it. In the ideal situation, you for sustainable trend. So you'd find a starting point. It usually be, obviously, to fit it on the screen here, there has been a bit of been squashed. It doesn't show you the true scenario, but you'll find a zero or prominent low or prominent high, and from there extrapolate it. So as long as the share price stays up above the trend line, the trend is bullish. Okay, and you can use it as an entry point to add more to a position. Okay, so there's our double top. We bought. You can add in more when it comes back to bouncing off it. So some of you might like to buy over there. I like to buy up a bit higher, just to confirm, this is adding to a winning position. But also, obviously, it highlights a changing trend. So when it breaks through it, don't act on that. That's where you put your stop. But as a sell signal, I like to use that a bit more safer. And say, okay, that would be my double bottom. That there would be a sell signal. So I'll substitute that zero for the sell. Okay, and obviously you can see from there further on the trend from there which is down. So that would have been a very, very reliable. That would have been your early trigger, and your stop. That would have been my confirmed sell signal to get out the trade. Okay. Or you can do the opposite now, obviously, with bullish support trend lines. So you don't just take the sell signal at the close as a close below the support trend line. You just use other confirmation signals, as I mentioned just now. Okay. Now this is an interesting little chart. Now they always say the trend your friend. The point and figure charts with trend lines are very, very powerful tools. So there's our first signal as a sell. There's our double bottom. We've got our sell signal. There we've got another sell signal. You can say that wasn't a sell there. That could have been another sell there. But all the time, the share price did not go above this resistance trend line. So it told you that the trend was down, and basically the share should have been avoided if you wanted to go long on the share. I wouldn't have had any buy signals, and this would have saved you money. Okay. Obviously, you would have gone short there. You could have added to your position there. The whole time the trend was down, you would be making money. But there was no buy signals to go long. That's where this is powerful. Okay. Let's move my cursor out of the way. See any more questions coming through. The question here from Peter. Thanks for the question, Peter. Okay, guys, just try to keep the questions a bit short because it's obviously I've got a very small or space to read the questions. Okay, yeah, good question. How do you decide on the interval? On the tutorial goes into more detail. I just play around with it. You know, if by default will have a certain look to the graph. So I look at the box size. I know either go bigger or smaller. You know, either make it 50 cents or 1 rand. If it's a penny stock, obviously you should look at a few cents. But I'll play around with it. You know, there's no real hard and fast rule, Peter. So yeah, just play around with it. The more information you have on the screen, the better. And obviously you don't want to have long lines up and down that you have to move the scale up and down. So, you know, obviously like with the index, you know, 500 points, it to shrink the chart a lot. So good question there. Is there a general rule? As I say, the tutorial does mention it. It depends on the price range. You know, if it's divided by 25 cents and divided by 50 cents, and then from there you can decide from there. But I just basically always just play around and chop and change until such time I have a decent fit and I feel comfortable with it. Okay. There's a question here. Sorry, Peter, you got a lot of questions all mixed up in time. Is it related to time frame? Close the day pricing. Yeah, obviously I'm using point and figure charts here on the in-a-day chart. So it'll be a daily chart. You can switch to a weekly chart. Obviously you're compressing a lot more information to it. So yeah, that's you can apply it to different time frames also. When it comes to more the day trading, the guys, what they usually do then is change the reversal. Instead of having a 3-point reversal, they change it to a 1-point reversal to make it a bit more sensitive. So the guys do use it for day trading also. Can this be used? This is a question here from Kevin. Can this be used for Forex? Yes. Point and figure charts can be applied to anything. Okay, remember it's a price chart. So they can be applied to anything. Thanks, Kevin, for that question. Okay. Guys, thanks a lot for the questions. Keep them coming through as we go along. Okay. Bullish resistance lines. This is basically creating a channel. So you got a bullish trend line because obviously the trend is up. You can see that with the naked eye. It's a resistance trend line because obviously there's a tendency to hit it and then come back. Hit it, come back. Hit it, come back. So I'll just do my cursor in again. That's what I was talking about. That's your resistance there. So obviously that's where you're going to see maybe some profit taking, and so it goes on. You can extrapolate it into the future. So that's what you use that bullish resistance trend lines for. Okay, let's move on to the next one. So get rid of my cursor quickly. Okay, obviously the opposite would be a bearish resistance trend line. Bearish support trend line. Again, we're supporting the prices here, extrapolated forward. But it's a tool to help you just make the charts more visual. You can see it's a downtrend. now suddenly you can see also at the bottom here, a bit of a sideways trend, so we're forming a base. So this is what I'm talking about here, a bit of a sideways market. So you're forming a base, so you want to see a breakout above this triple top soon, hopefully. Okay, so yeah, just down back. Let me just go, oops, sorry about this, guys. Charts and now jump back. Okay, let's get into what I feel the most important stuff, why I like to use point and figure charts, is what they call the horizontal and vertical counts. You can use it to calculate upside and downside targets. Okay, so this method obviously works better when we have a long period of accumulation, so we're forming a base where the supply and demand obviously have been backing each other. So we're moving sideways, we're going through consolidation phase. So when you look at point and figure charts, just think when you look at a bar chart, that sideways movement, you want to see it break out of that sideways movement, and you want to take advantage of that. So the bigger the base, the bigger the horizontal base, the more reliable and the higher the price projection will be. So how's it calculated? You'll see in the next graphs anyway. Here's an example. So first of all, your first thing you need to have is a buy signal. So a buy sell signal. In this situation, here's our buy signal from you can call it a triple top. There's my buy signal. In that same column then, you just move down and then count across the columns unbroken. So I count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So we got a horizontal count of 14. Okay, that's my 14 columns. Now I take that, multiplied by the box size. In this situation, you can see the box size, each box represents 5 cents. Okay, multiplied by the reversal. So 14 times 5 times 3. Okay, then you add it, whatever that resultant number is, to the lowest in this calculation. Okay, so you'll add it in this situation to the 0. Obviously, this might have been a new listing, whatever the case might be. So we've got a possible target of 2 and 10. That's the theory behind it. So here's a practical example, and here's a horizontal count of, in this situation, we've got 11. 11 times the box size of 201. Obviously, I'll get it from the top of the screen, times my reversal. So 11 times 201 comes to 22.11 cents, times my reversal. Okay, that's the resultant. Added to the lowest in this calculation, which I estimate, and it is an estimate, because I go down here and say, okay, I walk across and say it's roughly about 122. Okay, that plus that, I've got a potential target of 188 rand 33 cents. Okay, so if you calculate where we are now to that price, that gives you a potential gain of 22%. Yeah, you can see ultimately it does go way above that price. Okay. So remember, I'm buying here at whatever this price is. What's it? 144. Okay, I've got a target of 188. We eventually reach it. Okay, that's where it's powerful. Okay, in this situation, I've got a horizontal count of 17. I personally like to have a horizontal count of 10 plus. So that coming back to your question just now about the box sizes, I try and make it where I can see consolidations of at least 10. Okay, so obviously the smaller the box size, you'll be able to manipulate it around. But there's my buy signal. I move down, count across. In this situation, 17 times my box size times my reversal. Ultimately, I've got 55% potential gain to have. So there's my, oopsie, sorry guys. There's my buy signal. We're going to, we've got a buy signal here. What's that? Roughly about 165. We got a potential gain to 256. Would you go into the trade? Yes, I would go for it. Okay. So that's how it works. That's from the upside. You can do the similar calculation on the downside. Okay. All you do is you're subtracting the answer now from the highest point in the graph. So you'll see in the next graph what I mean by that. There we go. There's my sell signal from a triple bottom. Okay. There's my sell. I move up until I have a unbroken. We can even go to the column there. But I count across unbroken, 1, 2, 3, 4, 5, 6. Okay, so 6 times 5, that's my box size, times 3, so that's 30. 6 times 5 is 50, times 3 is 90 cents. So from my high in this consolidation, there's my high. So 90 cents minus, from my 100, I've got a potential target of 10 cents. Okay, so that's how we calculate it. That's how it works. Okay, so here we got a horizontal count. There's my bearish signal. In this situation, 17. So I've got a potential gained from, what's that, roughly about, say, 1780. We gain down to 1480. And you can see we get very close to it. We reach that target. Here we get a horizontal count of 19. Okay, as long as you have more than 10, as I say, that makes it reliable. So there we got our signal, we've got a potential making it, and we reach that target anyway. Okay. So I know we're using hindsight. Hindsight's perfect science, but I just want to show how these things work. Okay, they are powerful, it helps you project. So imagine this was today, you haven't got any information yet, that's what happens. You have that target. By the way, these horizontal counts, you're up to 80% probability factor. Only things you don't know when. So it can take a few months, a few weeks to a few months. You just don't know when. But you got potential target to go for. Okay, let's talk about a vertical cut. Okay, it's also based on the general principle that the higher the first column, in the upside, the higher the ultimate target. So it just works opposite now. There's our buy signal now. So I count from the bottom. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So obviously that's where our buy signal would have been. So far the price has moved up 13 crosses in our count. So 13 times 5 times 3. We added to the lowest in this consolidation, which is 15. Okay, from our count. So we got a potential target of 2.10. Okay, do the opposite. Obviously on the downside. So there's a long column here. That's 14. Again, 10 times more. As we've got a count of 10. But you've got potential of hitting that price. So there's our 208. We exceed it. We eventually get to it very, very closely. Okay. There's a vertical count of 10. There's a vertical count of 19. In this situation, only a vertical count of 9. Okay. You do on the downside also to help you estimate the target price. There's our triple bottom. There's our sell. We go up. Count from there. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So 11 blocks. 11 times our box size, times our reversal, whatever that number is, we subtract it from the highest in our consolidation. And we got a target price of 5 cents. Doesn't sound realistic when you're sitting at 120, you're going to 5 cents. And that will bring me to the next part of the question, is which one's more reliable? Okay, so the upside target is more dependable, as we're talking about the horizontal and the vertical counts together. Okay, both targets are more dependable if we have obviously a bullish market. The downside calculation is more dependable if we have a bear market. If you had to choose between a vertical count or a horizontal count, I personally prefer a horizontal count. It is more dependable. And let's say a consolidation of at least 10. That's what I'm looking for. The bigger the consolidation, the better, and obviously the stronger the breakout. Okay. But saying that, don't just make investment decisions on these point figure charts. Remember, it's an additional tool that you'd use. Okay, use other obviously fundamental and technical information. The more research you do, obviously the better. Okay. So just remember, there's no time limit to that target being attained. So it has a higher probability, 80% plus, and you think you don't know when it will reach that target. Okay, guys. Let me just quickly summarize and then conclude, and we can handle some more questions. I hope you found this presentation interesting. So just quickly again, remember it highlights a true picture of supply and demand. Yeah, you want to see the buyers overcoming the sellers. Obviously, that gives you a buy signal, and vice versa. The sellers overcoming the buyers, that gives you the sell signal. Okay, so it's simplified in the sense that we're only looking at price, and there's the three major advantages. Obviously, it highlights support and resistance levels, and obviously a consolidation. When the market's taking a bit of a breather, when the buyers and sellers having a bit of tug of war, that's what we call consolidation phase. The bigger the consolidation, the stronger the breakout. Okay, we talk about breakout trading, so this is where it's very, very powerful. And as I say, the main thing I use it for is for price targeting. Okay. So guys, just quickly to conclude, please go through the online tutorial. As I say, it's an additional resource for you. Please review the PowerPoint presentation, this presentation we're looking at, and also obviously to hear the whole recording again to reinforce the power of point and figure charts. Okay, so go load your own charting program. Go load up a point and figure charts. And go look for some of those patterns. Okay, so you use in conjunction with the presentation. Our WEN software does include point and figure charts. Remember, our software is free. All you have to do is subscribe to the download service. It's $169 per month. Okay. I've got a note here to look at for upcoming webinars and traders forums. We haven't finalized the dates as such, but will be most probably every Wednesday afternoon, like we're having now, going forward. The format's going to change slightly in the sense that it's going to be shorter. So instead of having an hour or 45 minutes webinar, we're going to have short half-an-hour webinars, but obviously more often. Okay. So let's see if there's any more questions coming through. Here's a question here from Rob. Hey. Sorry, Travis. Okay, what is the smallest time frame? Hello, Travis. Nice to see you and taking part here. That you can use the smallest time frame obviously is 1 point, 1 cent. We say time frame, you can use it for day charts, you can use it for intraday charts too. I personally have never used it. I'm not sure if the software I do use, Swordfish, has intraday charts on point and figure charts. So to answer your question, I'm not 100% sure, but I presume it will be available. I know that a lot of the guys use it on different time frames anyway. There's a question here from Terry. Do your high and low closing prices affect the chart? I'm not 100% sure the question here quickly. Do your high, low, and closing prices affect the chart? Obviously, the WEN, for example, automatically calculates the high-low range of the previous day and calculates how many little noughts and crosses. So yes, obviously the greater the volatility, obviously the more noughts and crosses you'll be able to include. So the shares that are very tightly held, the shares that don't trade so often, it might be skewed a bit. So rather look at free-dealing shares to trade point and figure charts. Okay. Question here from yes, I remember the presentation will be given out to everybody, all you guys that are on this presentation. So please review it. So you're getting the presentation and the recording. Okay, I've answered that question before. Can it be used for Forex? You can use it for anything. Okay, so I presume that answers my question about the timing. Can technical analysis be used to spot long-term trends, not only speculatively? Yes. So that's what you're going to use it for mainly. It eliminates the noise, the daily movement, the minor trend, and highlights the secondary trend, the support and resistance levels, the corrections and rallies. So yes, definitely, most definitely. You can play around with all the different intervals, daily and obviously weekly charts, even go quarterly, monthly, and then see where are the support and resistance levels. That's when you want to confirm those particular support and resistance levels. Okay, guys, it's all the questions that are coming through now. Okay, pleasure. Thanks a lot for the webinar. Pleasure. Thanks a lot, guys. Hope you enjoyed it. This is the last webinar for the year. So I hope you guys enjoyed. Obviously, it looks like point and figure, technical analysis is more popular than all the other. So going forward, we must probably have more and more chart patterns and technical analysis going forward. But I will have a more shorter, one particular subject, and then obviously a lot more examples around that. But guys, from my side, thanks a lot. Thanks for your support over the year. Have a great festive season. If you're driving anywhere, please drive safely. And let's all come back in the new year and let's make lots of money. And thanks a lot for your support again. Here's my contact details. Any questions you have, obviously pertaining around point and figure charts, let me know. If I haven't answered your question, I'll be following up on the questions anyway on Citrix. Okay. There's my number. There's my email address. But from my side, thanks a lot for your support. Thanks for attending this webinar. All the best. Keep well. Cheers. Bye.